Next up are Gerrienne and Susannah Taylor from Early Metrics with a dual keynote on Fintech ecosystem insights in 2021.
Brilliant. Welcome, everyone. After yesterday, I believe some of us might be a bit slower today. And congratulations to the Italians here and online, and congratulations also to the English team. You've done well. If you want to take revenge, I've heard that you should order pizza with pineapple on it. The Italians don't really like that. So that might be one way. Let me see if that works. Fantastic. So I want you to relax and sit back because it's Monday morning, and I want to take you on a journey. I want to take you on a journey to space. So imagine you are Richard Branson. He literally went to space yesterday. Imagine you're on his spaceship, right? And imagine you're sitting there and you're flying to space, and what you see there is the Milky Way. What do you see there? Thousands of stars, thousands of bright stars that are rising. Some of them are super shiny, and some of them eventually will die. They will vanish, right? And this is a perfect reflection of the startup ecosystem. How so? Because every day, thousands of startups, the stars, are being created. Some of them will turn into unicorns. They will be super bright and will continue to rise and shine. Some of them, or even most of them, will die, right? They will not make it. And that's why our founders, Antoine Basquiat and Sébastien Payet, back in the days, 7 years ago, decided to come up with a unique rating methodology to cut through the noise, make this ecosystem, which is super crowded and vast, more transparent, and bring more trust to this ecosystem. Because at the end of the day, trust is the ultimate currency, right? And you can think of Early Metrics as a bank that is sort of a bit middle person that saves our clients money, time, and as I said, brings more transparency and trust to this ecosystem. Because at the end of the day, trust is the ultimate currency, and without trust, there's no transaction. So how do we bring more transparency and more trust to this ecosystem? With our unique rating methodology, which we've developed 7 years ago. It's an algorithm that essentially looks at 150 data points, which is broken down into 30 criteria. And those 30 criteria are then again broken down into 3 key pillars: the team, the project, and the market. So what do we exactly look at? We look at the complementarity of the founders. We look at their capabilities, their skills, their experience. What kind of soft skills do they bring to the table? Then, of course, we look at the project. We look at the product development. We look at where does the innovation come from, right? If you look at the challenger banks, the innovation comes not from the offering in itself. It's mostly the way the customer experience has been reinvented almost, right? And then we look at the project skills. And to finish it off or round it off, we look at the market, the addressable market size, the competitive landscape, and also the time to market. And overall, we've looked at 30,000 startups so far, and our algorithm has analyzed all those startups to sort of gather insights into the growth potential of those startups, the key success factors, et cetera, et cetera. And my colleague, my fantastic colleague, who I haven't introduced yet, Susannah, will share some of those insights specifically to our today's session, which is green finance, fintechs. And yeah, without further ado, I'm going to hand over to Susannah. And again, also on behalf of Early Metrics, I would like to thank Barclays Rise for being here. And it's a fantastic opportunity. Thank you.
Thanks, Dean. So I think sustainability is often listed as kind of a fintech trend in itself, and we don't tend to go into too much detail about what that really entails. So what we've done today is had a look, as Dean mentioned, through our database of almost 4,000 rated startups to establish the biggest kind of trends and emerging technologies within that database. So obviously it's very clear that corporations, funds, small businesses are all becoming more aware of the need for those solid ESG credentials. And emerging fintechs are springing up to meet these challenges. So for today's purposes, we've identified 3 key areas: impact investing, green banking and payments, and ESG tracking and reporting. And you can see on the side here some examples of what each of those services consist of. And I think it's interesting to note that the technology we're talking about here, particularly in terms of the more consumer-facing products, is not necessarily, groundbreaking. We're talking about relatively well-established functions like APIs and open banking, using data to personalize services, excellent UX and UI, and in some cases, just good old-fashioned planting trees. So in my opinion, the real appeal and innovation of these services is what they're offering the user, and these are the 4 elements we've identified at the bottom of the side. I know they sound a bit buzzwordy, so here's what we actually mean by them. Visibility, so a promise on the part of the service provider to disclose exactly how and where deposits are being used. Transparency, they're in the wrong order. Anyway, so agency, giving choice back to the consumer. So maybe they have specific requirements. For example, they only want to invest in halal companies, or they prefer not to fund natural gas projects. They're able to customize and tailor the services they use to align with their values. Visibility, so clear metrics in order to track both financial performance and environmental impact. So, for example, I might be able to receive cashback in return for making a low-carbon purchasing decision, or an app might be able to alert me if my spending this week is about to reach a certain threshold of carbon emissions. And none of these things really matter if the app or the platform or whatever it might be doesn't work well. And I think, as we know, this is one of the advantages that fintechs traditionally have over incumbent service providers. It's that they tend to be digitally native, simpler, more intuitive, and more engaging. So on the next slide, we're going to take a look at some of the context that is allowing these emerging startups to flourish. And we focused here on the UK, but of course some of these points are applicable globally. Firstly, in terms of policy, so after Brexit, the UK and in particular London is really jostling to retain its position as a leading centre of financial activity on the world stage. And with international banks starting to move their headquarters abroad, it's increasingly looking like London might be at risk of losing out in this process. So Bloomberg has found that sustainable investment products are set to be worth over 53 trillion by 2025, which is more than the global market for corporate bonds, which means that in Europe, with the leader of kind of the green finance environment not really established, London is very aware that it has an opportunity here that it really needs to seize. And that's reflected in policy. So, for example, in last year's 10-point green plan, the final point was a pledge to make London the green finance capital of the world. Then there's the changing consumer landscape, in particular when it comes to investing. Whether it's because of the availability of information or the immediacy of the threat, the generation of investors that are now coming of age really care how their money is used, and specifically that it's not contributing to the demise of the planet. So the rise of ESG products is coinciding with this coming of age of millennial capital. These are people with financial resources, a point of view on how their money should be used, and nimble enough portfolios that they can make the transition to sustainable investing without it being overly difficult or costly. This is more speculation than anything else, but I also have the impression that events like GameStop and things like that are starting to turn on a much younger generation to the idea that they can get involved in financial markets without necessarily having huge access to capital. So increasingly, this kind of investment market is going to become more and more democratized, which will result in a wider base of generally younger and generally more sustainably minded investors. So even if you don't necessarily have the resources to, say, make strategic investments with your savings, which a lot of young people don't, you can control how your pension is managed. So Cushion, which is a net zero pension provider, has found that switching your pension and investments to a sustainable fund can be 27 times more effective in the fight against climate change than veganism and not flying combined. And many consumers are making the choice to make this switch. I think when PensionBee, who we just heard from, launched their sustainable fund, £100 million worth of funds were switched over to it within 34 days. I think this generation, as well as others, are becoming increasingly wary of those traditional incumbent service providers. The lack of visibility and control is leading to something of a trust gap, as well as accusations of greenwashing against companies who are traditionally perceived as not necessarily concerned with consequences. That said, most of the big banks have pledged net zero by 2050, but that is a long way off, and in the meantime, agile fintechs are springing up to fill the gap. And of course, this is all reflected in VC activity. So investment into green finance started to accelerate around 2019, grew 50% in 2020, and is set to outpace last year again this year in terms of deal count and value. It's also worth noting that there's been over 2,000 studies conducted into this since the 70s, and all of them point to a positive correlation between ESG and financial performance. So all parties really do stand to benefit. So now we're going to take a quick look at the technology that's actually powering these solutions. The big one is obviously data. It's kind of, in a way, what enables all of these services, and they wouldn't work without access to these vast swathes of user data. It's what enables, for example, an alternative investment fund to build a plan personalized to your values, and then an AI robot that can advise you along your investment journey. It's what allows green banking apps to track the carbon impact of your spending and reward or penalize you in return. And it's what is going to enable us to massively scale up ESG reporting without relying on increased time or manpower. So open banking really is linked to data, but it means that these integrations mean that they can now sit on top of your bank account and understand your spending in order to give recommendations, make assessments, calculations, and so on. Artificial intelligence, similar to data, is heavily implicated in a lot of these different services, particularly when it comes to automated or predictive features. But it's of particular interest when it comes to ESG reporting. We're starting to see that algorithms can be trained to detect market events that will possibly impact sustainability, use natural language processing and machine learning to extract vast amounts of information from unstructured data, and even in some cases analyze sentiment to establish the credibility of ESG claims. And lastly, distributed ledger technologies and blockchain. Obviously, their key selling point is the immutability and therefore total trustworthiness. So if you imagine a company is able to store their ESG credentials in the blockchain, it would be very, very difficult to doubt or query. Just move to the next one.
Yes.
Thank you. So as Jean mentioned earlier, we've got a database of almost 4,000 rated companies, and we also have a continuous process called backtesting, where we check the accuracy of our model and also ascertain the growth and survival rate of companies rated in years prior. And this means that when we look into our database, we can extract certain trends and patterns. So for today, we have looked at our database as a whole compared to fintech companies within the database, and then specifically sustainable fintech companies. And that's enabled us, using the backtesting data, to actually understand the top criteria for startups of this kind to be successful. Number one, perhaps unsurprisingly, is the ability to finance the development of the company. So that means essentially having the cash runway available to execute the technical and commercial development plan. And this is very, very closely linked to point 2, which is ability to convince. And what we mean by this is the ability of the founding or management team to onboard relevant people to the project, which is obviously crucial when it comes to raising funds. Number 3 is availability for the project. Often we see, particularly with early stage startups, that the founders might be dedicating maybe 20-30% of their time to the new endeavor, and the rest is dedicated to elsewhere. And obviously that has a negative impact on the development of the company. Last year, we actually worked with the Barclays Rise and Techstars Accelerator program, and we saw several instances of founders who, in the process of the program, realized they needed to be dedicating 100% of their time to the business, made the decision to do so, and had a really profound impact on the way that their company developed. Number 4 is commercial traction. If a company has been operational for a while and is showing no clear signs of commercial progress, then that instantly throws up a red flag. The earlier a company starts to establish its consumer base, the more assured its future is. It means that the product market fit has been validated, and they're starting to capture market share over their competitors. The last point is access to networks. And again, we saw with the Barclays Accelerator program, you really cannot underestimate the impact of good mentorship and access to relevant networks. And it's not just about raising funds, it's about leveraging outside expertise in order to make sure your product is developing in the right direction, or to create commercial opportunities. So then we've looked at how sustainable fintech companies compare to our database as a whole. It's interesting, fintech companies generally versus our database averages, there's very little difference. But there is a fairly significant underperformance on the part of sustainable fintechs. Particularly in the qualitative elements, which are the things that Jean mentioned right at the beginning of the presentation. Sustainable fintech startups score lower than our average, and the project and market score are most effective. If we move to the next slide, we can understand a bit more about that. So the project score is adversely affected by what we call a lack of innovation. And you can see here that 80% of these companies are web platforms or mobile apps, which means they're not really developing strong barriers to entry against competitors. In an area which is where the competition is particularly dense. The difference in funds raised can also be understood a bit better when we see that 70% of these companies are early stage pre-revenue startups. So they're at the very beginning of their journey, essentially. What we can really see from this is that this is clearly a burgeoning market which is developing very, very fast and has enormous potential. We've seen a massive proliferation of solutions recently, and ultimately it remains to be seen which ones will win out to dominate the market. Thank you very much.
Great.